You're watching another episode of Startup My Startup with John Cole. And today we're going to talk about investor relations. John, can you share a little bit more about this topic?
Sure. It's a really important part and piece of you taking in investor money. So remember, we talked about in the first few podcasts, we talked about what investors listen to, how to present to investors. And we also talked about setting up your pitch deck, writing your pitch deck, presenting the pitch deck, writing your business plan. So now you're in a place where you're out there and you're actually talking to investors. And there's some paperwork that you're going to need to have in place when you start taking in money, whether it's you're setting up a convertible note or you're selling equity in the company or it's debt. However you're bringing in investor money, you have to have your back end compliance in place. And that's what we're going to talk about today. So I want to share the screen with you.
Okay.
And can you see this here? Is it sitting there?
No.
All right, hold on one sec here. Why can't I get this right? Oh, man. So we need to, can you like stop it for a second?
I've got it.
I can't find it. Why is this, but the share button's not coming up. Hold on. All right, so let's just start right from here.
Mm-hmm.
So what I'm going to share with you, can you see this, Exhibit A?
Yes.
Okay, great. So Exhibit A, this is what's called a Instructions to Investors and Subscription Agreement, or sometimes it's just called a subscription agreement. And basically what it explains is what you're getting for your investment. In this particular case, this was tied to or accompanied a private placement memorandum. This particular company was doing a 504, SEC 504 offering, and they were raising capital. I believe it was, it says down here, wherever it was, I think it was $3 million. And this is what the investor reads and fills out. And who provides this is an SEC attorney. I just want to let everyone know I'm not an SEC attorney. I handle investor relations for companies and set up shareholder compliance and shareholder servicing. But this is one of the documents that you might see or might use when you're raising money. And in this particular case, it's called, this particular document, again, it's called Instructions to Investors and Subscription Agreement. And where it says here in red, that would be the company name. It's Exhibit A. Over here, where I'm circling, I don't know if you can see it, where to the right, where it says copy number 28. That's real important because you always want to tie out a number to all the paperwork. And in this particular document, it says, please read carefully the confidential private placement memorandum of company name dated and all exhibits met with the memorandum before deciding to describe all capitalized terms utilized herein shall have the same meaning as set forth in the memorandum. So basically what this does is it qualifies the investor.
Mm-hmm.
And in your company, there's a difference between an accredited investor and a non-accredited investor.
Mm-hmm.
And let me kind of walk you through that. So in the rules, in the SEC rules of a 506 or a 504 offering, you're allowed to have up to 35 non-accredited investors, but everyone else has to be investors. So if you had 100 investors, you can only have 35 non-accredited. All the rest have to be accredited. And I'm going to scroll down here, and then I'll go back up, and I'm going to read you what accredited investor means. So right here in number 4, it says, if a natural person, I hereby represent and warrant, and you're going to check the appropriate boxes below, that I have an individual net worth or a joint net worth with my spouse, not including the value of my primary residence, of more than $1 million. And again, in parentheses, not including your personal residence. So let's say, how do you get to $1 million net worth? So let's say, it's like you, Kate, you own a business and your business is worth, let's say it's worth $350,000 today, your business, if you were going to sell it.
Mm-hmm.
And then let's say you have a vacation home and it's worth $750,000. Well, $350,000 plus $750,000, you have the $1 million net worth right there. But it also includes jewelry, art, automobiles, all the assets that you own that have a value. In most cases, it's not hard for people to get over $1 million valuation on the value of their assets. But you cannot include your personal residence. They used to allow you that, but they don't anymore. So that's one way you qualify as an accredited investor to write a check into a private company, is you're an accredited investor with $1 million net worth. But also if you don't have a $1 million net worth and you're an individual, you can qualify with $200,000 of joint income, or $200,000 of single income, individual income, or $300,000 a year with your spouse in each of the 2 most recent years. And you would say, I have a reasonable expectation of reaching the same income and level in the current year. So there's 2 ways to qualify as an accredited investor to invest in a private company. In this particular case, you either have $1 million net worth, or if you're an individual, you can show that you have an income of $200,000, or if you're married, you can show that you have an income of $300,000. So those are the 2 ways to qualify. But you have to check all the boxes here. Now, the Securities and Exchange Commission, or the IRS, or any federal state agency, they don't ask you to prove what you're checking here. You're going to sign the document, you're going to read all the disclosures and disclaimers. And basically, you're saying that you're telling the truth here, and this is what you're filling out. But it goes down here in all these boxes you check. If other than a natural person, such entity represents and warrants, check if appropriate, that I am an accredited investor under the Rule 501 Regulation D under Securities Act of 1933. And then you go down here and you check all the other appropriate boxes. And also what they're really asking here, they want to make sure that the investor has some level of education and that they have been, and they understand the investment. And you'll see in here, there's verbiage and words in here at the very end to talk about representations, warranties, and covenants of the investor. And they read all this. It says, I understand that in this event, the agreement is not accepted, then the funds transmitted herein shall be returned to me. I acknowledge that I have read fully and understand the memorandum and all attachments and exhibits to the memorandum about the company. My overall commitment to investments that are not readily marketable is not disappropriate to my individual net worth. So there's all these check marks and all these qualifications to make sure that you understand the investment. Then it says here, I hereby agree and indemnify, defend, and hold harmless the company because I understand I've read all the disclosures and disclaimers. Again, you're allowed to have 35 unaccredited investors and up to 35 unaccredited investors, and the rest all have to be accredited investors. This is how I coach companies when they come to me and they ask how many should we take in unaccredited investors. I tell them don't take in any unaccredited investors. It can be kind of a nightmare. It can be kind of it's a place you just don't want to go. Have all your investors be accredited investors. It makes it a lot simpler. They've checked all the boxes. There's nothing illegal or anything wrong with having unaccredited investors, but it just makes more sense if you could have all accredited investors. It makes it much more easier. But it does give you the option to have unaccredited investors if you want. So this is a standard subscription agreement that they would fill out. Now, once this gets all filled out, they sign it, their spouse signs it. They've read everything, they've checked all the right boxes, and they're going to attach their check or cashier's check to this. They're going to print their name, the exact name they want in the registration. In other words, when it says here in registration information, that's the name that's going to go on the stock certificate that they're going to get. So if I'm John Cole and I'm investing in a company, but I want to put it in my JAC Enterprises Inc. company, then I'd put JAC Enterprises Inc. because that's how I want to hold the shares. And then the address, the principal address, and distribution address, where you want to receive following information and correspondence from the company, your phone number, email, and then primary state that you're in. And I don't want to get off the track too far, but the primary state is really important because there's blue sky rules when you're investing in companies, and there's certain states that you cannot take money from if you're in certain states. So and
Mhm.
there's a list of them. There's a list of like, I can't remember, but I think one of the states is, if you're in California, you can't take investments from New York. And it's just what
Okay.
the SEC
Mhm.
puts in. So example like that.
Mhm.
So then you would fill this out and then you attach your cashier's check or a personal check to it and send it into the company with this paperwork.
Mhm.
And or you have an opportunity, you can just wire it in, and here the wire instructions would be here: bank, the name of the bank, address, routing number, SWIFT code if it's a company, if it's coming from Europe, beneficiary name, beneficiary account. So this paperwork goes into what is called an investor file. It goes into the investor file with a copy of your check, and everything's compliant. And then you have what is called an investor file checklist. Can you see this?
No, I only see the same document.
All right, let me just pull it out here. Hold on one second. Let me just drop that and drop that. Whoop, screen sharing. And I'm gonna share. You just have to find it. Oh my gosh, I can't find it. Let me just pull it up. Hold on one second.
Mhm.
So I have it up, but you can't see it. So let me do this. Screen share. There it is. Investor checklist.
Well,
You see it?
yeah,
Okay, great.
perfect.
So this is a cover sheet that goes inside the investor file. It's called the investor file checklist. And this is very important because what you're doing is you're setting up your back-end investor relations to always be audit ready. I'm not talking about auditors coming in from the IRS or a federal state agency. That could happen, but it rarely ever happens. You want to be audit ready because at some point you're probably going to go to your bookkeeper or your CPA or your accounting firm. And at some point you're going to move away from being an unaudited company to an audited company. That is your tax returns being audited. And you want to have all this information in here, and your CPA or your auditing firm is going to ask for it. So investor file checklist, you put the shareholder's name. And then right there, you see off to the right, accredited or not accredited. You circle that or highlight which one it is. And then you have the investor referred by. That's really important. Who was it referred by? It may have been referred by an already existing shareholder, but you want to put the person who referred this investor to the company. Then the prospectus number. Remember, I had that number 28 on the subscription agreement. That would go there. The date invested, the actual date they invested, which is the date on the check. Subscription questionnaire and file. You circle or highlight yes. Amount invested. Let's say they invested 50,000. You put 50,000 there, and then you put the share price. What are they getting? Are they buying it at $1 a share or 50 cents a share or $2 a share? If they're the share price, if they're buying it at 50 cents a share, you put 50 cents there, and the number of shares would be, if they invested 50,000, would be, number of shares would be 100,000 based on the arithmetic, based on the math. Then date money deposited in the company bank account. That's really important. So you're building a paper trail here, a data trail. So you may get a check on Monday. You may hold it for a few days or maybe even a week and then deposit all the checks in on a Friday. So you want to put that date right to the day you deposit it in the bank, which is your business bank account. Form of payment. Was it a personal check, a company check, cashier's check, or a wire? You highlight or circle one of those. And then the check number. You put the check number there. And then the copy of the check in the file, yes, no, NA, you put yes, circled yes, it's in the file. Copy of wire instructions. If they wired, you circle that. Yes, they wired. Stock certificate number. When you give them a stock certificate, because they've invested now they're going to get a stock certificate from the company, you write the stock certificate number there so it ties out to the investment. Date certificate issued. You may get the check on Monday. You may not deposit the check till Friday. You may not issue the stock certificate to the following Friday. And then on the date the certificate was issued, maybe the following Monday. And all those may be different dates, and they typically are within a few days to a week of each other. The CUSIP number, there is no CUSIP number. That will be assigned once, if the company goes public, that's a CUSIP number assigned by the transfer agent. But there's nothing to put in there now. Date stock certificate mailed to shareholder. That's important so you can kind of track it. And then how you mailed it. Did you mail it FedEx? Typically you do. You typically mail stock certificates of some sort of insurance or bonding, so you know it gets there and you have a return receipt. And then stock certificate copy and file, yes or no? Yes, that's very critical. You copy the stock certificate before you send it to them. And then the receipt of stock certificate and file. There's an actual receipt that you send with the stock certificate that the shareholder signs and sends back to you. They send it back in a return envelope.
Okay.
And in here you have the shareholder address, all the basics: city, state, zip code, county or country, phone number, cell number, email, and then any comments you want to write down here. And these comments are this section where it says comments, this is your conversation log with the shareholder. Like you may put in here at the top is, I spoke with the shareholder, I followed up with the shareholder, and he did receive his stock certificate and he sent us his receipt back. And you just write that there and you put the date when you talk to them. So you have those footnotes. And then if you send out a shareholder communication or an update on the company, or you called them and provided information from them, you write it in there. And this is just a phone log and a communication log, whether it's emails or phones. So this is this form goes in the investor file with the subscription document that we just went over, along with a copy of their check or their wire instructions. And that's the whole file. You've now built the physical investor file. People always ask sometimes, gosh, do I need to give you show proof of my of my income through my tax returns? Nope. You don't need to ask that, because they've signed and they've checked all the boxes and they've signed and kind of certified it in that subscription questionnaire that all the information they put in there is true. So you don't need to verify their income. We're not a state, or the company's a private company. It's not a state or federal agency that it does that. So they never ask for that. So then what you do is you duplicate this and you set it up into a data room. So you have an electronic data room and you have a physical file on location at the company headquarters. So that's how you take in money. In this particular case, it was a private placement memorandum. And then what happens is, now that you got the money in and you've got these accredited investors in your company, now you got to start communicating with them, right? Now you got to start giving them updates. And you and I, Kate, we've talked about this before. I can actually take this down. Stop sharing. We've talked about this before, where what do you do with shareholders? Because the investor, as soon as they give you money, they're not really an investor anymore. They're a shareholder. They're an owner in the company, and they deserve to be communicated to. They deserve to be updated on a regular basis. Now, that's completely up to the founders and the chief executive officer or the president of the company or the board of directors, how often you will communicate with shareholders. Everyone has their own philosophy. My philosophy as investor relations, if I was working with your company and I was a consultant handling investor relations, I would reach out to shareholders either via a phone call, email, or a shareholder communication at least once a quarter. Now, some will tell you, oh no, that's not enough. You should be talking to them once every month.
But not every day, right?
Not every day, no, not every day. Or some will say, you just need to talk to them once every 6 months. But here's the issue. This is why it's so critical to have an investor relations professional either on your staff when you start raising money, or at least working from the outside, like myself as a subcontractor, so I can field those emails and those inbound phone calls and keep them away from the chief executive officer, because the chief executive officer and the president and the COO and the CFO of the company, they're running the company. And every time they got to stop and talk to shareholders, it can be kind of a stop, change, start. It's kind of a little bit of an interruption. So now some people have a different philosophy. Some chief executive officers and the C-level officers of the company, executive management team, they want to talk to the shareholders. In that case, go ahead, you should do that. But when I had my own company and I raised money, I was the chief operating officer of my company and I was handling investor relations. And if a shareholder called my office in the morning or called the company in the morning, and for some reason I was in a meeting or none of us could take a call, I never went home until I called that shareholder back at the end of the day. because
Wow.
shareholders really appreciate that. And those calls, they only take 5 minutes. Now, yes, you'll get a one of those shareholders that's going to be a pain in the you know what. They're going to be emailing you all the time. They're going to be looking at the market. They're going to be sketchy people. They're not sketchy people. They're going to be really skittish about the market. And, hey, I saw the market Dow went down today. Well, how's that affect my stock? We're a private company. I'm getting nervous. How you guys doing? What's going on? What's happening? Hey, call me. That stuff happens. And you get investors like that. And you just got to communicate with them. You just got to stay in touch with them. What I have found, the investors who are like really wealthy and they've been investing in stocks for a long time and they're old, seasoned veterans at investing in private companies, and they're kind of, they know this risk reward circle and conversation. You don't hear from them. They write a big fat check to the company. They just want to be talked to once a year. And as long as you're giving them a shareholder communication once every couple of months or 3 months, they're fine. They're good. Usually the people who just have barely enough money to invest and they're investing, even though they're a accredited investor, you can tell they're going to be taking up a lot of your time. But again, remember I said it back in a couple of our couple of podcasts, when you're raising money and you're running a company, it's like running 2 different companies at the same time. You're running your company in day-to-day operations and building your companies and handling the marketing and doing the development of your company. And you got to put this hat on and you got to talk to shareholders. That's why at some point, it's so important to bring in an investor relations professional to handle and be a buffer and handle all the communications and forward-facing communications of the company. And that's what my company does. It provides investor relations, corporate communications, and shareholder servicing. Corporate communications encumbers writing the shareholder communications, writing the drafts for the executive management team, and then they, do the edits and sign off on it, and then you send it out to all the shareholders on behalf of the executive management team. There may be some announcement that you have to put into the public market, so you have to write press releases, and that's what my company does. We write press releases for the company. And we also will communicate with the street and Wall Street and the analysts, and we'll handle all the inbound calls because it's a whole nother business in itself. So that's one of the services. That's why investor relations, after you start raising money, you need to start thinking when you're going to bring someone on. And you don't need to bring an investor relations person on full time. They can walk with you before they run. So as you're a startup company and you're raising 100,000 today from friends and family, and you may not need a investor relations. And then you do a second round of friends and family for 250,000. You may not need an investor relations person because you only may have a handful of investors at that point. But when you get to about 12 investors or more, that's when you want to start to bring on an investor relations person. And that investor relations person can work remotely as a consultant to your company and handle all your inbound shareholder calls.
Nice.
That's why this process is so important. And then we get into corporate communications, where we're talking about press releases, corporate communications. You're kind of giving the shareholders the brand awareness, full disclosures, business integrity. Managing a crisis is a thing too. Like sometimes, you've heard crisis management before, right? You've heard that terminology. And you've got to be able to communicate the bad with the good to the shareholders. You've got to be able to keep them abreast of what's happening in the company. For instance, here's an example. We said we would do $1 million in sales by April, and it's May now, and we've only done $250,000 in sales. Well, you should communicate that to the shareholders in some form or fashion. It's not always the greatest news they want to hear, but what I found out about investors, they know there's a risk, especially with private companies and startup companies. There is a period of time that's going to be risky while they're waiting for the company to develop and grow. And there's going to be stumbling blocks. And there's going to be times where, even when I had my company, we went down this path. We found out that wasn't the right path, and we had to pull back out, do a pivot, and go down the other path. You got to let shareholders know that. You got to just let them know that what's going on in the company. And again, those calls only take about 5 minutes, and they're happy just to hear from someone in the company.
That's nice. But like you said, the more investors, the bigger
More
the company grows, the harder
Yeah,
to
and I've been
manage.
investor relations for, both private and public companies. And the public company I was a shareholder, I was an director of investor relations for, we had probably over 2,000 investors,
Mhm.
and I was managing a dozen analysts from Wall Street. So that
Wow.
was pretty heavy commitment. And then I was with a private company where we had almost 800 shareholders privately.
Wow.
And so at that point, you are handling, that's a full-time in-house job, and you're handling all those shareholders. So, but as you start to grow the company, as I always say, the boat pulls away from the dock and you start to pick up some speed and you're building your company and you're growing it, and now you're making money, at some point, as the executive management team, you don't want to be talking to the shareholders. You want someone else doing that, communicating
Same
for you.
time.
Yeah,
True.
and then from time to time, one of the things that you do as an investor relations person, you set up what are called CEO calls. Like
Mhm.
once a quarter, you may set up a Zoom call for all the shareholders to come on at once, and you take questions in advance of setting up the Zoom call, and then you say, okay, here's the 10 questions that were sent to us by all the shareholders, and we're going to address those. We're going to tell you where we're at. We're going to tell you what our revenue is. Let's talk about what our debt is. Let's talk about some really cool things that are happening in the company. Let's talk about a couple of things where we didn't make it. And shareholders appreciate that if you can just be in communication with them. It's
Mhm.
real important. So crisis management is always something you want to handle. And then there's this thing called material. What is material?
Mhm.
If you're a public company and you have a material event happen, let's say you go out to do $1 million, but you only make 100,000, or one of the research and development projects you're working on kind of doesn't go well or blow up and it changes the course of the business of the company. You got to communicate that. That's a regulation as a public company. But if you're a private company, you don't have to necessarily provide those material events to the shareholders. You're not obligated under any kind of rule or regulation if you're private.
Mhm.
The other thing is, as a private company, the reason why we did the audit with all the, the investor checklist and all the paperwork,
Mhm.
investors, if you're a private company, they have the right to come and visit your company headquarters, set up a meeting, and review the company's books and look at all the paperwork. So that you want to be ready for. And again, you're doing that to be audit ready when you transition from being a private company that's unaudited. At some point, when you start to go look for and raise the bigger money, let's say you're getting ready for an acquisition, you're either acquiring someone or you're looking at your company's being looked at as a roll-up target, or you're looking at an IPO or pre-IPO, you're going to have to move into this transition into being an audited company by a legitimate, by a well-known or a company that does audits, tax audits. So that's investor relations. I don't know if you have any other questions but that's pretty much it. It's simple, but having someone be kind of your mouthpiece and your forward-facing communicator as you grow is really important. And again, you don't have to bring anyone on full-time. They can work with you part-time. My company's really flexible. You tell us how many hours you need. We work with you. If you need someone to write press releases, we do that. Shareholder compliance, SEC compliance. That's really.
Nice. Thank you so much, John. I do think that, again, like once you start growing bigger, you don't have time as a business owner to talk to investors and to spend your time there because you get distracted, from one subject to another one. So I totally see that where you would need someone like you who can handle those communications. So thank you so much for this video and for so useful information. And we'll see you soon.
Thanks. Thank you very much.